So we have our primary focus for the next 12 to 18 months is going to be Canada. We've got some existing production there of around 300 barrels a day. We just drilled a discovery oil well over the Christmas and New Year period, and that tested at about 400 barrels a day. We're going to be bringing that on in the next couple of weeks, and we're funded to drill 2 more wells in Canada during the course of this year. We do have a very clear vision to grow this company to a mid-tier oil and gas producer, and we'll do that via organic growth, and I've just alluded to some of the ways we'll do that organic growth, and also by acquisition, and I'll take you through some of that. So just a snapshot of where we are today. We've got roughly 40,000 acres net to us in central Alberta. We're funded, as I mentioned, to drill a couple of wells this year. We will be looking at a target production rate of 800 to 1,000 barrels a day by the end of the year, and that's going to obviously move us into quite a different place than where we are today, with an enterprise value of $6 million. So I mentioned we're going to drill 2 more wells this year. The first one we'll be bringing on in the next few weeks. And I think importantly, there's about another 15 wells to drill into this oil field. So we're going to have a busy 2020 as well as we look to double up on our drilling program again through 2020. So why we like Canada, it's obviously a tier 1 country as far as the regulatory environment, and it's very stable. But I guess the key point is it's got low drilling costs and very speedy approvals, and coming from Australia, that makes it very attractive compared to some of the regulatory challenges that we're having today in Australia. It's a very transparent and easy to get access to independent technical data, which we see as a critical issue when we review new projects. And it's underutilised as far as the drilling activity over the last few years. We've obviously seen an advent of horizontal drilling and completion technology, and that really hasn't been used in the conventional sands, which is where we are targeting. And so there's lots of opportunities to identify oil pools as we have ourselves in the last 9 months, by looking at old logs, identifying where perhaps wells have discovered oil in the 60s and 70s, obviously uneconomic at that time due to the technology and the oil price for that matter. And there's really been very little drilling and utilisation of that technology, which is well understood now, and primarily been driven out of obviously the shale boom to be reapplied into these conventional sands. The other thing that we're now seeing in Canada is it's really difficult environment there at the moment. The industry is made up primarily of a lot of small independent junior oil and gas companies. They've found it very difficult over the last few years, and hence why there hasn't been a lot of drilling. So that it really is ripe for acquisition. And picking up nice assets in what is a fairly challenging environment. But from our perspective, that creates the opportunity. So right now we're building a pipeline and a pad which we'll drill 4 horizontal wells off, as well as set up our surface facilities. The work started a couple of weeks ago. It should be finished within the next 2 weeks. It's been a little bit slow due to the weather at the moment. But we'll still aim to have that first discovery well online at the end of the month and pumping oil in June. So we're obviously looking forward to that. And just an example of the cost comparison that we're seeing. So all of that work is costing us about $650,000 for a pipeline, a pad, and the facilities and road and everything that goes with that. So it really is an attractive place to do business at the moment. The next 2 wells I alluded to, the first one we'll be drilling in the middle of the year, Rex 2. That'll be about a 1,500 metre well with a 1,500 metre horizontal. We'll frack that as well, and that'll cost us around $2.3 million. We'll drill the next well towards the end of the year. That'll have a slightly longer horizontal leg to maximise our access to the reservoir, and we're looking at IP rates of up to 600 barrels a day, which our neighbours are getting about 10 kilometres away. So very exciting time for the company. We've got a lot of work on in the next 6 months. We're funded to do it. And of course, we see this process being repeated and repeated and repeated as we grow our business there. So I guess just to sort of trying to bring all that together, we'll be bringing the first well on in the next few weeks, the second one in the middle of the year, and the third one at the end of the year. We're funded to do all that. Our target production is about 1,000 barrels a day by the end of the year. Our gross margin on that is about $30 Canadian a barrel, so you can do the numbers fairly quickly. We've got an enterprise value at the moment of $6 million, so it is a really very simple growth story that's basically fully funded. And as I mentioned, outside of this particular activity, we'll obviously be looking for our next pull to do the same thing again. And I mentioned earlier on that we're not only looking at this very strong organic growth path that we're on, but also looking at acquisitions, because we see the current difficult conditions there as potentially providing some opportunities to buy high quality assets in a tier 1 country at discounted prices to what we might see in other places in North America and certainly Australia. So I guess what I wanted to leave you with was we've got some very clear objectives. We think we're on a fairly low risk within the range of risk that we have in this particular industry. And the next time you see me standing up here next year, then we won't be the smallest company in the room. Thank you.